Howdy, Jacob here. Today we're looking at company 43 of our dividend yield stock screener, ticker symbol E. Let's look at some of the financials here. So $54.3 billion market cap with 58.1 billion in enterprise value. So that little under 4 billion in net debt. Not too much. They're in the oil, gas, and consumable fuels industry, and the company is headquartered in Rome, Italy. Um, Currently, zero point 0.9 price to book, 9.7 PE looks pretty cheap from that perspective. You can see that in the last 2 years, very, very good earnings per share in comparison to the prior 8 years. So it could just be a jump in oil price that is causing this. And then we can see it's dropped quite a bit, both on the revenue side and net income side. On the balance sheet, 65 in current assets, hard assets, total is that 80, 145, still grading liabilities, that's good. So 20.5 billion long-term debt with 4.3 in capital leases. Let's see what that 20.5 is in comparison to free cash flow. So here we have 10, 9, 0, 5, 7. I don't think 20 is too much debt for them. That's a reasonable amount of debt, and been paying it back quite a bit the last 2 years when they've been producing very healthy free cash flow. So something to note, their capital expenditures have gone down a little bit from what they were in the beginning of 20 teens, 2013 to 2015. Um, the cash from operations is pretty equivalent, not too far off. Obviously, a weird year during COVID, but as expected, when oil prices went negative for a day, that was pretty crazy. Buying back a bit of shares recently with that excess free cash flow, buying companies through acquisitions, 2 billion, 1.8, 1 billion. That's a lot of money to be acquiring businesses. So it looks like the first 2013 to 2016, very heavy declines, probably through selling off parts of the business, big sell off here, big sell off in 2017. Interesting. Okay. So, and this is all over the place. Again, I think if we start to get to some assumptions here, it's been very, very high recently, price of oil, and we can see that in the revenue and earnings, but might be a company I just say, you know what, they'll probably decline quite a bit in the short term, but get back to where they are now sometime over the next 7 years. Um, Not too much debt. I don't see a reason to need too much margin of safety here. If we look at what do these earnings look like? Okay, so all right, so if I shoot in 5 and 7, buy back 1% of shares, $1.97. How much was their payout? Paid out a little over 3 billion. I mean, they can afford that. Have they increased, decreased their dividend? They have. Their dividend's been going up and down quite a bit, but they can definitely afford this dividend in comparison to their last 5 years, probably averaging maybe 7 billion. So they can afford that less than 50% payout. I might just assume that it's flat, and then if it gets to a price that looks attractive and I start doing a deeper dive, I'll be able to tell more accurately if that's a fair assumption or not. But as of right now, this is probably something I might wait on just because price doesn't look super attractive given all these assumptions. However, this is a company that I would put on your dividend yield screener or your list of dividend stocks, companies to own, due to the fact that their payout is reasonable and produces a 6% yield. And so even if we get to assumption where, the company's stock price may go up 1 to 4% only, you're still getting that 6% dividend yield through excess, just free cash flow and just sitting on your butt getting that money. So this would be a company I'd add to your list, but me personally is definitely something that I would wait a little bit before buying, because it doesn't look super attractive given the current price. So thank you, and I hope you have a good rest of the day.